And one of the questions that he slid me, Thomas Hayes, who I'm sure you know well as well, he slid me a question saying there's 10-to-1 demand to supply for NVIDIA on the chips front. Do we need more progress on fabrication, especially considering TSMC and Intel right now, to help fulfill some of that demand?
That's a great, and he's great, and that's a great question. It's true. I mean, because ultimately you need more supply, you need more production. The problem is, like, look, Intel, I mean, they're stuck in that right lane, 45 miles an hour in a minivan, right? Like, so that's part of the problem. But it's a demand supply issue. Demand's not the problem, it's supply.
All right. Dan, thank you so much for taking the time here with us just after the opening bell. We appreciate it. On Wall Street, strategists see AI and economic data replacing tariffs and the tax bill as the big focus for investors going forward. Barclays strategists expecting more gains for stocks with AI driving earnings. Joining me now, we've got Thomas Hayes, who is the Great Hill Capital Chairman and Managing Member. Thomas, great to have you here on set with us today.
Great to be with you, Brad.
Absolutely. I had to try and squeeze your question in with our previous guest, Dan Ives, but I got to know as well, since you are also very closely tracking this space in AI, how are you looking at AI and how it's playing into the broader market rally right now?
Yeah, look, I think Dan is spot on. The demand exceeds supply by 10-to-1, and that's the issue with NVIDIA right now. Their business model depends on the kindness of strangers. So Taiwan Semiconductor has limited their revenue growth each quarter to $4 billion because that's all they can fulfill. So for the next phase of NVIDIA's growth, you need to see those fabs get finished by Taiwan Semiconductor to increase capacity. And I think the dark horse that no one's paying attention to, you've seen a stealth rally in, Intel 45 miles an hour in the slow lane, 10% plus this week. And I think part of that is Lip-Bu Tan is cutting staff. I think the other part is they're the only game in town with fabs at the 10-yard line ready to spike the football and the touchdown. There are chips being tested on their fabs. And I think if they can be a part of that supply solution to NVIDIA and others, that could be kind of a dark horse. So while you see maybe NVIDIA double, if Intel gets it right, it could be meaningful.
That also raises a similar question that we had brought up in our previous conversation with regard to how many of those chips will be able to be shipped to other parts of the world if so much of the money that's helped Intel get to this point has really been prioritized at bringing up and scaling up production here in the U.S.
Yeah, well, I think once they get that production set, I think the sky's the limit as far as global demand. And I don't think they need to be best in class. I think there's going to be so much unlimited demand that anyone that can produce, even second tier.
That's a weird call to say, hey, just be mediocre in class.
By the way, that's my base case with Intel, is they are the leader of mediocre chips. And by the way, as they bring this capacity online with Lip-Bu Tan, he did unbelievable things at Cadence Designs. That was a multi-bagger. No one's better. He's going to fix it. They're going to be part of the solution. It's going to help NVIDIA. It's going to help Intel, et cetera. And it's going to help boring, normal businesses that implement AI, which Dan alluded to, which is going to be huge, which no one's looking at right now. Right now, you think AI, you think Mag 7, you think Palantir, you think NVIDIA, but the big beneficiaries are also going to be real businesses.
What needs to continue to take place or transpire within business spending towards AI to really continue to allow the AI trade to keep its foothold on this market and be the kind of core barometer of the investment psyche, if you will?
Yeah, it's really interesting because you see the Mag 7, and there's like a good news is they're benefiting from the AI trade. The bad news is their earnings growth is collapsing because they are doing all this CapEx. So Q1 of this year, earnings growth in Mag 7 was 27%. Q1 of next year, 2026, earnings growth is going to be 10.2, but the multiples have not really compressed. No. Then you take the unmagnificent 493, all the boring companies that are going to benefit from these technologies in terms of implementation, their earnings growth was negative. It's going to be 10.3%, and the multiple is meaningfully lower. So I think there's a lot of unexpected AI opportunities. If you take Brad Jacobs, for instance, he does all these roll-ups. QXO, where he buys boring businesses, building supply companies, et cetera, and he goes in and he doubles EBITDA with technology. He's a huge implementer of these technologies in boring businesses. GXO Logistics, they're one of the first businesses using humanoid robots to help move the stuff in the different distribution centers and warehouses. So it's pretty wild.
I've got Brad Jacobs' book on my desk. Thank you for sending that, Brad, by the way, from one Brad to another. Just lastly on this topic here, because we're going to discuss a range of topics throughout the morning here, but as you think through the leaders of the tech rally right now versus the rotation that we could see, names that have been underappreciated, where are those parts of that trade?
Yeah, I think, the market's going to continue to push higher for the next 4 weeks. Why? Partially because of global liquidity is back at an all-time high, partially because earnings expectations are really low. They've taken them down from 9.3% to 4.9%. So that's going to drive the bus. Mag 7 is kind of back up to the top of the range despite earnings growth deceleration. So I do think as you kind of stabilize after we make those new highs and everyone gets euphoric and tech's got to push it up because of the weight in the indices, I think that second half of the year where you're going to benefit is the unmagnificent 493. But it's interesting. I'm looking at today, small caps are outperforming the NASDAQ. So Russell 2000 outperforming the NASDAQ, outperforming the Dow Jones, outperforming the S&P 500. That is the small cap index is the most shorted in history right now. And these are the type of companies that benefit from these technologies. And I think you're going to see the back half a big surprise in the 493 in small caps in companies that will be beneficiaries of the great things that the NVIDIAs of the world are providing.
All right, Thomas, we got a lot more to discuss here. You're with us all morning. We've got much more on Catalyst as well here. Markets action, of course, some of your top picks for the round 2 of the NBA draft as well. If you want, you're watching Market Catalyst. We got a lot to get to. Stay tuned. President Trump may name his next pick for Fed chair earlier than expected. Joining us now with a closer look at the top candidates, we've got Fed correspondent Jennifer Schonberger. Jennifer, what do we know?
Good morning, Brad. Furious over the Fed's wait-and-see slow walk approach to cutting interest rates, President Donald Trump is considering announcing a new Fed chair early to undermine current Fed Chair Jay Powell, whose term doesn't end until next May. Longtime economic advisor to Trump, Steve Moore, told me this morning that the president is considering announcing a new Fed chair pick soon, that he sees it as a shot across the bow to Powell. Another person close to the administration said that we could see an announcement in late fall, maybe late September. The Wall Street Journal initially reported that the president could announce a new Fed chair this fall as early as this summer. But according to a White House official, no Federal Reserve chairman decisions are imminent, although the president has the right to change his mind. The president has many good options for the next Fed chairman, I'm told. Treasury Secretary Scott Bessent had previously said that the administration wouldn't start interviewing candidates until the fall. But Wednesday, President Trump told reporters he is actively considering a replacement to Fed Chair Powell, but stopped short of offering specific names.
I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
Under consideration are said to be Treasury Secretary Scott Bessent, former Fed Governor Kevin Warsh, National Economic Council Director Kevin Hassett, and David Malpass. Fed Governor Chris Waller's name has also been floated, but Steve Moore told me that the president is not happy that Fed Governor Waller did not vote in favor of cutting rates at the Fed's last policy meeting. I'm also hearing from someone else who's close to the administration that the president is souring on Kevin Warsh. And yet a third person told me that Scott Bessent is the president's top pick for the next Fed chair, but that the president is trying to determine who would replace Bessent as Treasury Secretary, and that it wouldn't be Commerce Secretary Howard Lutnick, who had initially jockeyed for that position. Now, an early announcement could undermine the Powell and the current Fed's announcements for the path of policy and could influence investors' expectations for the path of policy. Of course, it's ultimately the bond market that is going to determine the yields and the rates. Powell made it clear that politics does not enter the Fed's decision-making. He told Senate lawmakers yesterday during a hearing that the Fed really wants to do what's right for the economy, and they just want to make sure that the president's tariffs don't lead to inflation.
That's our job. If we make a mistake here, people will pay a benefit, will pay the cost for a long time. And so we're just approaching the question carefully. That's all we're doing.
So, Jennifer, sticking with the Federal Reserve, the central bank has released a plan to ease capital requirements on big Wall Street banks. What can you tell us there?
Yeah, Brad, banks are elated over this. This is really seen as the first step to peeling back a lot of those regulations for banks that were put in place post-financial crisis under Dodd-Frank. And the new vice chair of supervision at the Federal Reserve, Mickey Bowman, sort of set the table for that on Monday during a speech when she said that she and the Federal Reserve are looking at making changes to other capital requirements. And yesterday we heard from Fed Chair Powell himself during that Senate Banking Committee hearing that the Fed is actively looking at changes to Basel III, and the changes that were proposed yesterday to the enhanced supplemental leverage ratio is certainly the first step in that direction. We also know that the Fed is looking at changes to those stress tests.
Okay, Jennifer, thank you. Still here with me, we've got Thomas Hayes, Great Hill Capital Chairman and Managing Member here. So, as we think about the SLR, of course, as we're hearing from Fed Chair Jay Powell, who was commenting on it during his 2-day stints on Capitol Hill, both discussing with the House Financial Services Committee and then additionally with the Senate yesterday here, this question came up. The SLR was supposed to act as a backstop to risk-based capital requirements. Too often, the SLR acts as a binding requirement for U.S. banks. They went on to ask, would you agree that adjusting the SLR would free up capital for banks to invest more in treasury markets and other low-risk assets that would be beneficial to families and businesses across the country? And on net, he agreed. Yeah. So what is the significance of that? What should banks expect from this point forward?
This is the biggest news of the summer, okay, and maybe of 2025. Effectively, what it's going to do is enable banks to own a ton of treasuries. They're not going to have to post capital against it. So they can do that. They can get the yield. And banks' preference, they tend to buy on the short end of the curve. So in terms of mortgage rates, how does that really help? And that's the argument people make. Well, what's the difference if Powell cuts because the 10-year yield dictates the mortgage rates? What happens is they can issue short-term and do an operation twist like they did in 2012. Besson can do it at the Treasury and buy in the longer end of the curve, which could bring down the 10-year yield by 30 to 70 basis points. If that happens, you could see a 30-year fixed rate mortgage by the end of this year in the high fives, below 6%. Once that happens, the demand for housing is going to be off the charts because basically Powell has delayed the dreams of 72 million millennials by artificially holding rates 200 basis points above inflation, highly restrictive, and you see the average age of a new home purchase has gone up so much since Powell has been.
It's 38 now.
It's 38, and that becomes late to start a family. It becomes late to have kids. So a whole generation has been hurt by wrong-minded policy. And if and when Trump announces a shadow Fed chair, Powell immediately becomes a lame duck for the rest of his term because the market will start to price in. Let's just say it's Kevin Hassett.
Sure.
Very dovish. The market will begin to price in 200 basis points of cuts in 2026 immediately. Powell will have zero power from that point forward. So when he says the end of September, he's basically saying, time to move or I'm going to go with this. You got to move in July or you got to move in September or I'm announcing the shadow Fed and you're effectively out even if you want to stay in the chair for 6 more months.
That's really interesting. Thomas, you're sticking with us for much more to break down throughout this hour. And next, all of our markets action ahead. Stay tuned. You're watching Market Catalysts. 1 hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Joining us now, we've got Yahoo Finance's Ali Canal. Ali, what are you seeing down there or up there in Times Square?
Hi, Brad. Yes, well, I'm seeing a sea of green at this point. All three major indexes trading in the green here. We're seeing gains led by the tech-heavy NASDAQ composite, although all three major indexes are roughly trading about 0.5% higher there. If we take a look under the hood of the NASDAQ, especially the NASDAQ 100, which just continues to build on that record high, I want to take a look at NVIDIA here. If we look at the Wi-Fi Interactive 2, we can see that three-year chart, we are up over 800%. We had that record close yesterday, continuing to add on to those gains. But it hasn't been simple, right? We haven't seen this straight rise to the top here. It's actually been a bit of a bumpy ride. So I thought that was interesting that we now have this V-shaped recovery, not just for a name like NVIDIA, but also for a lot of those other equities here. We can also take a look at the yields and the dollar, because yields right now, they are edging a bit lower today after we heard from President Trump that he wants to select a Fed pick soon. The announcement could come by late September, and according to our own Jennifer Schomburger, candidates include Treasury Secretary Scott Bessent, former Fed Governor Kevin Warsh, and National Economic Council Director Kevin Hassett. Clearly, we know that Trump wants a more dovish candidate there, so that will directly impact and correlate those yields. And then the dollar, same thing there. We're seeing that edge lower. Year to date, we are down about 11% there. There's been a lot of talk about U.S. exceptionalism and how, we could potentially be in a sell America trade, but I don't think at this point that is materializing. However, we still are seeing some of that dollar weakness right now, Brad.
Allie, thanks so much up there at Times Square at the NASDAQ. Appreciate it. Now time for some of today's trending tickers. We are watching Kratos. We'll get the pronunciation there. Kratos Acuity and McCormick. First up, Kratos Defense and Security Solutions. Not one we talk about all the time, but they are offering nearly 13 million shares of its common stock today, worth roughly $500 million. The technology company plans to use the proceeds for expansion of its existing national security programs, new acquisitions, and to pay down debt and expenses. Shares are falling after the announcement. I want to bring in Thomas Hayes, who is the Great Hill Capital chairman and managing member here. Shares right now, they're lower by about 1.8% here. Where does this company fit within the broader kind of defense mindset among investors from what you've seen? Yeah,
well, the bad news is it's dilutive, so the shares are down a little bit. The good news is they couldn't have timed it any better, which is what bankers tend to do. 5% of GDP spending coming out of NATO for all these nations, so good time to go out with an equity offering for a defense company. Unmanned systems, satellite business, missile defense, it's kind of the sweet spot of what everyone's been focused on this week. They raised $500 million. They can grow, they can expand, and they're going to benefit from the trends.
Yeah, it seems like Benchmark raising its price target to $48 from $40. They maintain their buy rating on this stock here, and we'll see exactly what this means in terms of how that funding and how that capital gets infused into the business and put to work as well for some of those scaling efforts here. We're also tracking Acuity this morning. Acuity reporting third quarter estimates that beat the street's estimates, both the top and bottom lines here. The electrical equipment producer saw revenue jump over 20% year over year. The company, which makes smart lighting fixtures, saw sales top $1 billion in the latest quarter. And shares, they're ripping to the upside right now by about 6% here, sending the shares up above $305 now a share right now, intraday here, Thomas.
Yeah, no question. I mean, this is a preview of coming attractions. I think we're going into this Q2 earnings season with very low expectations. Sentiment is still in the gutter. If you remember the Bank of America Fund Manager survey from last week,
yes,
institutional managers have lower sentiment than they did during the COVID lows and even going back to the Great Financial. It's starting to come off the bottom, but you don't top in markets when sentiment is that low among 222 managers they surveyed with $500 billion of assets. So they're playing catch up, and companies like Acuity, you deliver the numbers, you're going to get bid up.
Yeah, it was really interesting. The chairman, president, and CEO, Neil Ash, saying that we grew net sales, expanded our adjusted operating profit and adjusted operating profit margin, and increased their adjusted diluted earnings per share, generated strong cash flow, allocated capital effectively. That kind of hits on all the check boxes that investors are looking for going into this report.
So we want to see these beats, and we want to see the raised guidance, and that's going to continue to be the theme in coming weeks.
Absolutely. And finally here, McCormick beating expectations for its second quarter. McCormick also reiterated its full year 2025 guidance, with the company's CEO saying they have, quote, robust plans to mitigate current tariff-related costs. That's despite several potential headwinds for the consumer staple market, including dietary changes, trade uncertainty, and inflation. You're taking a look at shares of McCormick, higher by about 5.3% on the back of these results. We were talking in the break about how much I take pride in my own seasonings and the cooking of the proteins necessarily. You got to have a little flavor in there.
Yeah, there's no question about it. And I'm looking at, I look at sectors, they call me turnaround Tom. I like to buy businesses that are out of favor. I'm looking at consumer staples and defensives, and you're seeing a lot in that group, whether it's Kraft Heinz, there was some recent news out, General Mills, Hormel. These are all kind of left for dead stock. So, you seeing McCormick's earnings, this might be a preview of coming attractions for some of those that have kind of been unfavored of late or unseasoned of late. And maybe coming through this earnings season, they start to get interesting, particularly when volatility picks up in the fall and money moves a little bit more defensively. So keep your eye on consumer staples, packaged products, and the like.
If it wasn't so hot outside, I'd be ready to go outside and season with some McCormick, but it's pretty toasty, awesome. So I don't need to be by the grill. Yeah. Thomas, stick around. Right. We've got more here. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. All your markets action straight ahead. Stay tuned. You're watching Market Catalyst. Shell is in early talks to acquire rival BP, according to a Wall Street Journal report. People familiar with the matter say talks between company representatives are active and that BP is considering the approach carefully. But Shell is dismissing the report, telling the Journal it's, quote, further market speculation and no talks are taking place. A possible combination of the energy companies could end up as the biggest oil deal since Exxon and Mobil's $80 billion plus merger more than 25 years ago. And you can see on this chart some of the biggest deals in history in the energy space. Exxon and Mobil back in 1998, Shell's acquisition of BG Group in 2015, and more recently, ExxonMobil acquiring Pioneer, plus Occidental's deal with Anadarko Petroleum. Now, one of the other things to keep in mind is what the outlook has been. Even though we saw in November, once investors were trying to wrap their minds around what the election results meant and if there would be more of a mindset for deal making, we haven't seen that fully play out just yet. And even coming into the first and second quarter of this year, we got some commentary from EY Parthenon, and in their expectations, they are looking for a slight rise in total U.S. deal volume in 2025 for deals over $100 million. So when we're talking tens of billions of dollars worth of deals, you can bet that the tires are going to get ticked and kicked just a little bit harder. While Shell is denying the Wall Street Journal report that it's in talks with BP about a possible merger, our next guest says a deal could be a first step towards improving the valuations of the combined company. Here with more, we've got Rob Thummel, who is the Tortoise Senior Portfolio Manager and Managing Director. Great to have you here with us. So just take us into your analysis of the deal-making environment now through the lens of Shell and BP and what it could mean for the sector.
Well, so thanks for having me. So if you just look at what's happening in the overall sector, obviously commodity prices are down, oil prices are down a lot, and so it's hard for deals to be made today just because of the lower oil price. And a lot of these oil and gas producers, oil producers in particular, have really repaired their balance sheet, so they don't need to do deals. But it's a little different for Shell and BP. So if you look at the valuations of Shell and BP, they're really low. They trade at much lower valuations than their peers, Exxon, Chevron, Total. So obviously there are a lot of investors that are looking for ways to unlock that value. I know Elliot's been active in BP to try to encourage them to sell several of their assets to try to realize and get the market to recognize more of a sum of the parts type of valuation. So does it make sense for the two to combine? Yeah, it probably does longer term. If you think about then what will a combined entity do? It's much bigger, and then ultimately what it needs to do, and I think both companies need to do, is continue to be disciplined, continue to deliver cash back to the shareholders in the form of dividends and stock buybacks, and I think you put all those together, then ultimately it result in an improving valuation. But clearly both of these stocks are at really discounted valuations.
What is the likelihood that this deal even goes through, knowing that there are now more restrictions in different parts of the world for this to be necessary or be possible to take place, considering British stock regulations that have now come more into light, which would mean that essentially there would be a 6-month period that Shell would have to wait if this indeed was rejected, and ultimately they would have to find some other approach.
Yeah, I think the odds of Shell buying BP as it is today is very low. What I think the more realistic possibility is that BP starts to sell off certain pieces of its business, and then ultimately a combination between Shell and BP makes a little more sense. I think BP is obviously interested in the oil and gas producing assets, the Gulf of Mexico, some of its international oil and gas producing assets. And I think BP has a little bit of LNG as well that would be complementary. But there are other businesses, I think, inside of BP that may make sense in the hands of other buyers rather than Shell.
What does this tell you about the geographical differentiation and perhaps diversification of portfolios for some of the largest energy companies that they're looking to accelerate at a rapid clip right now?
Well, what I think it tells you is all oil and gas producers right now are a little bit more mature in their cycle in terms of their business cycle. So they're a little bit more mature. What are they looking to do? Well, they're always looking to maximize value to shareholders. And how are they doing that? Well, they're improving their free cash flow profile. And one of the ways to improve your free cash flow profile is to simply consolidate with somebody else, recognize the synergies over time, and ultimately generate more free cash flow. And ultimately, once again, with the goal of getting that free cash flow back in the hands of investors and ultimately boosting your stock price. So that's kind of the goal at the present time for all oil and gas producers, whether you're international or domestic.
And so at what price would this not make sense? Would investors need to push back on the tag for BP and Shell combining?
Well, I think you have to look at the relative prices between both stocks, and right now, Shell trades at a little higher multiple than BP. So depending on how each stock moved, that would be more of the driver of when the price doesn't make sense. But right now, with Shell trading at a discount, with BP trading at a discount to Shell, it makes a lot of sense for some combination to occur of certain assets that BP owns.
And then just lastly, while we have you here, thinking through overall in the energy sector, how much more consolidation we can expect to see. We were just running through some of the expectations as per through the eyes of EY Parthenon, and I think that was updated in April of this year. We haven't seen perhaps as much deal making as was anticipated coming into Trump 2.0, but it seems like there are still talks that are transpiring and moving forward. What does this tell you about the appetite for some of these larger businesses to really try and solidify their own operations or synergize going forward?
Yeah, well, what I think it tells you is, I think, so first of all, the entire oil and gas producing sector has done a pretty phenomenal job since 2020 of really redefining their businesses, turning into free cash flow making companies. And so they've reduced their debt significantly. So balance sheets are in much better shape in this environment than we've seen in the past, at least in my 30 years of investing in energy stocks. And the net result of that is in low commodity price environments, there doesn't need to be a lot of consolidation. So I don't think you're going to see a lot of consolidation because of the lower commodity price environment we're in right now. Obviously, we've had a significant amount of consolidation in the last couple of years, as you've highlighted, and a lot of those companies are still in the process of finding those synergies and improving those synergies, and that's probably a more robust way and prudent way of looking at the sector right now. Focus on what you bought in the last couple of years, improve what you bought, but before you just go out and look to buy something else.
Rob, thank you for taking the time here with us today. We got to leave the conversation there. Appreciate it.
Thank you.
Coming up, what pending home sales say about the sluggish housing market, plus what that means for home builder stocks. Much more ahead on Catalyst. Pending home sales rose 1.8% in the month of May, according to the National Association of Realtors. Sales increased 1.1% from a year ago. It follows a 6.3% drop in April, which brought pending home sales to their lowest level since the pandemic. Here to break down the data, we've got Yahoo Finance senior housing reporter Claire Boston. Claire, This uptick, is it good news for the housing market?
Yeah, so this is a better than expected report for contract activity here. That being said, as you mentioned, the April numbers were so bad, we are working off of a very, very low base. And so I think in terms of what we see from here, this was May data, so that is historically kind of the peak of the spring home buying season. And these are not gangbusters numbers. That being said, it does indicate that there's a little bit more activity, at least than what we saw, this time last year.
And so, Claire, earlier this week, new home sales fell to a 7-month low, but existing home sales, we saw those actually come in above expectations, remaining roughly flat month over month here. Taken together, what does this tell us about the housing market in totality?
Yeah, we're definitely in kind of a weird place in the housing market. When I talk to people about what's happening with new versus existing homes, this is really a substitution effect. There's actually inventory on the existing home side this spring. And as a result, some of those buyers that maybe would have gone for the new home because there was literally nothing to buy, now they're actually able to find an existing home that fits their needs. And, as a result, we are seeing new home sales weaken, existing homes improving a little bit. It remains to be seen kind of how that supply and demand balances out in the rest of the year when we're still, short housing units in this country.
I want to bring back in Thomas Hayes of Great Hill Capital into the conversation because you did not mince words on the Fed's role within this earlier. So given what we're seeing transpire within the housing market right now, to what extent is that the Fed? To what extent is that also just a byproduct of people needing to figure out, okay, how much home can they afford, the affordability issue, and then the number of people that are also just still sitting on their homes because they got locked in at very good rates?
Well, that's the problem. I mean, you run rates 200 basis points above inflation, you have unintended consequences. Number one, unaffordability for the 72 millennials who want to start a family. And number two is all these baby boomers that want to get out of their equity, but they're not going to sell a $2 million house, take out $1 million equity, and then go into a 7% mortgage when they're in a 3% mortgage. So I think the name of the game this summer is that the SLR is going to bring down the 10-year Treasury 30 to 70 basis points. You're going to see 30-year fixed rate go below 6%. And at that level, I think you're going to see a huge amount of inventory. And then you look at the home builders, okay? Who wants to risk capital building massive amounts of starter homes at 7% and have them sit in inventory? They can't make the investment. And this is the unintended consequence of one guy trying to protect his legacy and not be Arthur Burns. And the conditions of the economy are not, and the demographics are nothing like they were in the 70s. So they've got to move. And if they don't move, we're going to get a shadow Fed, and that's going to move the market. And he can just sit in the desk for 7 months until he leaves.
I mean, it's not fun being Fed Chair Jerome Powell because you are the face of the decisions that a body of people and Fed governors make within that committee.
You know what? In fairness, you had autopilot in December 2018. You remember that crashed the S&P 20% until Mnuchin came in and fixed it. You had transitory. So listen, I mean, his legacy is his legacy. He's got a chance to do it right and go out a winner like Seinfeld, and he's missing the boat. So he's got July. Let's see what happens in the next few weeks, and he can be an absolute champion and help 72 million millennials get their families started and get in new houses, help the home builders. And by the way, housing is 16.2% of GDP. You know how many jobs that creates that are being held up by this artificially restrictive environment?
Claire, last word goes to you. What does this mean for the home builders? What are we hearing on that front?
Yeah, I mean, the builders, we are already seeing them pull back. It is very hard for them to make money right now. Their margins are compressing. And so, we will have to see. They would love lower rates, obviously. And so we'll see what we get. That being said, the demand is not there, and they're not going to build just for fun. So, they could come back, but right now, they don't really want to kind of stick their neck out and build a whole lot.
It's interesting. The one home builder name that was moving higher here on the day, Toll Brothers, the super luxury end of that home building scale here.
Which doesn't help the millennials at all.
Claire, thanks so much for helping us break down this data. Tom, stick around with us. We've got a little bit more to discuss here. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere.
ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer
90 minutes into the start of U.S. trading. I'm Brad Smith. Let's get a look at the markets here. Taking a glance at the major averages, you've got the Dow, the S&P 500, and the NASDAQ all in positive territory, holding on to gains as we begin today's trading activity. 90 minutes in, fractional gains, 0.7% for the Dow, 0.6% for the S&P 500 and the NASDAQ. Flipping on over to the bond market, taking a look at the 5-year, slumping right now by about 0.9%. You're also taking a look at a move lower here by about 3 basis points for the 10-year yield, 1 basis point for the 30-year yield. Coming up this hour on Market Catalyst, first up, we break down the market rally and get a read on the AI trade as NVIDIA powers to a record high. Plus, we look at policy risks facing investors with just 2 weeks left to pass the tax bill and close some critical trade deals. And what can we expect from the brand of the swoosh, Nike? The company reports results later after the close. We'll get the latest read on the turnaround and much more on Market Catalysts. Time now for Investor Playbook. AI computing demand boosting Micron's latest results with Wall Street optimistic as the company delivered an upbeat forecast. The chip maker getting its price target boosted to $155 from $120 at UBS. It's down slightly on the day, but what do results mean for the AI trade? Joining me now, we've got Paul Meeks, 17 Asset Management CIO and Water Tower Research Managing Director. Paul, always a pleasure to grab some time with you here. So just as you're thinking about this broader AI trade right now and where it sits within your own mindset and how you're seeing that also perhaps play out among the street, where do you believe the next major catalyst comes forward for the AI trade?
Well, the interesting thing, Brad, is remember when DeepSeek was revealed several months ago? A lot of people were saying, that's peak AI, that's specifically peak NVIDIA. We've just received evidence as we go from building these large language models to large language model reasoning that there is an upside to the CapEx that the hyperscalers are willing to spend on AI infrastructure. So what we'll just need to see over this particular year, there probably won't be any surprises, but remember there was doubt just a few months ago, is that they execute their plans. It looks like there are other AI drivers, such as NVIDIA's CEO Jensen Huang talks about robotics being the next big thing. And I'm very comfortable with the trade. We will continue to build infrastructure, and we will continue to see more and more ways to monetize AI, which is important for those who are spending the dough as we go through 25 and probably even into 2026.
And so what does that spend profile look like on perhaps a more prolonged basis? Because that's going to be critical to seeing what the average growth rate looks like over time, which is what investors will be tracking for the how much they should be pricing into the forward valuation as well.
Brad, that's the $64,000 question. Thanks for answering it. It's very difficult to really figure out over time, what's the secular growth rate going to be? We Wall Street analysts are saying, okay, the secular growth rate of a company, either top or bottom line, is 20%, so maybe it gets a long-term terminal PE multiple of 20 times earnings. It'll be interesting to see. I do think that spending will be heavy, maybe even accelerate for the next year or so. But when you have companies that are multi-trillion market caps, it is very difficult to continue to grow them at current rates. But man, over time, 15, 20, 25% per annum, I think would be great.
And so how then does the international demand picture also need to transpire? Because as we've been discussing throughout the morning, it's also a question of where demand will also come in from other parts of the world for some of these very U.S. focused or at least U.S. traded chip stocks.
Well, we know that Trump and company, spent a great deal of time the last couple of weeks in the Middle East. And of course, everybody's talking about the next AI driver being sovereign AI. And of course, the countries in the Middle East can spend, and they've committed to spend. I need to see over time what happens, how this settles between the U.S. and China, because that is over time going to be a giant market, and it is absolutely imperative for the U.S. that they can send in, if we're going to keep the AI party going, their high-end GPUs into China from the United States.
You know, it's very easy to start and stop the conversation in some cases with the AI trade at chips, but we know that the chips are really just what this broader language learning model sits on top of, and then on top of that is the applications. And so with that stack, where are these secondary, perhaps the best secondary AI trades that are non-chip related that are starting to emerge?
So first of all, I think it might be hidden in the likes of Amazon, right? Because of the operating efficiencies. CEO Jeff Chassie just talked about 1,000 use cases already being implemented within the Amazon company. But then also, as you monetize AI, you go from hardware, which includes servers and semiconductors, as you just pointed out, more to software. And I still think we might have an opportunity here in Oracle if it pulls back. I also like SAP in Europe and ServiceNow, even Microsoft, though I think it's a bit expensive at present. These should be the next wave players as we monetize AI and software apps.
And we've also heard energy be one of the perhaps kind of third rail discussions around AI, but it's remarkable that it's even third rail because it is so significant in making sure that the data centers can be powered. And you hear companies like what you were just talking about in SAP, the Oracle, the Salesforces, all saying, okay, we need to get our investors ready for our investments that we might make in nuclear reactors. And so how is that also perhaps one of the other areas that investors are trying to understand where it needs to also have some of the broader kind of fit within their portfolio if they are having a holistic AI approach?
Well, we know that AI has a voracious demand for power, so I wouldn't say it's third rail. I think it's much more prominent than that. And you have seen, Brad, over the last year or so, some big moves in companies like Vistra and Constellation Energy Group. The only thing I worry about that is not the demand. The demand is strong and strengthening, is that to either recommission or build from greenfield a pretty large nuclear facility, that's a multi-year process. So probably in the near term, these small modular reactors are the way to go, quicker to ramp up, not so onerous, but we'll see. But yes, over time, we need to develop and groom a lot more energy from every source, not just nuclear.
You've had some of these companies make, and I think back to what Micron said on their earnings calls, the company announced an incremental $30 billion in U.S. investments as part of its approximately $200 billion long-term plan over the next 20 plus years. How would investors like to see that? How should they like to see that ultimately play out and phase out over time?
Yeah. You know, it's great. I'm an American patriot, just like everybody else, to bring semiconductor manufacture back home. But man, that is difficult. Like, for example, SoftBank and TSMC announced a huge AI factory in Phoenix, Arizona. And think about it. That might be the most exciting project. And you have a Japanese company and a Taiwanese company in Arizona. So these days, you know, really the only manufacturers in the States have been Intel, but that company's in a lot of trouble. Micron, which is doing quite well, as we know, and maybe Texas Instruments and a couple of other firms. I don't know if it is feasible, except in a couple of isolated cases, to full scale bring semiconductor manufacturing back to the States. It just may not ever be cost effective, and we may not control the IP in the States. We might have a physical plant that you can touch and feel in the United States, but again, being run by Taiwan Semiconductor, Samsung, or SoftBank.
Paul, really interesting. We're going to continue to track, of course, all of these developments, as we know you will as well. Thank you so much for taking the time.
See you, Brad.
See ya. Coming up, the big, beautiful bill, as it's been dubbed by the Trump administration. What changes are being made? We've got the details next on Market Catalyst. Congressional Republicans are running out of time to pass President Trump's big, beautiful tax bill before the self-imposed July 4th deadline. Trump demanded senators get the deal done this week in a post Tuesday on Truth Social. So what needs to get done before now and between now and July 4th. Washington correspondent Ben Werschel joins me now to explain. Ben, what do we know?
Yeah, Brad. So the Senate already had a really long to-do list here about getting this bill. They need to get this bill passed by this weekend to get it back to the House to meet this July 4th deadline. And that list got even longer this morning. We had a ruling from the Senate parliamentarian about Medicaid cuts that is really significant for this bill. This is a piece of the legislation that's a major pay for. And she advised at least that a piece around provider taxes should be removed from the bill. This has major implications for the healthcare sector, but it also has major implications for the price tag. We're talking hundreds of billions of dollars that this bill could cost more expensive now if that provision is removed. And this is part of a larger series of complications in recent days that all seem to be rowing in this direction of the bill getting more complicated and also more expensive. The parliamentarian has talked about SNAP cuts and how some of those provisions need to come out. That's another major way they were trying to save money in this bill. And that's in addition to the state and local tax debate that's raging on, and there's no sort of sense of how that's gonna end. That's the overall picture here. And I was speaking to Erica York at the Tax Foundation just a few minutes ago as this was breaking, and she made the point that in addition to all these directions going in the direction of a bigger price tag, that makes the task all that much more difficult. As she put it, there are a lot of challenges to overcome if this is going to get done in the next 8 days. Senator John Thune was speaking to reporters just a couple minutes ago, and he did acknowledge, he said the timetable could change a little bit. He was hoping for votes to start tomorrow. We're going to see how much that changes for certain.
And so, Ben, the president is scheduled to hold an event today as well, we know, touting the benefits of the tax bill. What do you expect? What are the anticipations of what we can hear?
Yeah, so this is being billed as a one big beautiful event. It's going to be at 4 p.m. in the East Room of the White House. What I would not expect is a detailed policy conversation about this bill. This is more about politics. This is a show of force. There's going to be a lot of lawmakers on hand. They're standing next to the president to say we need to get this done. And that's what's saying. President Trump has been a little bit preoccupied with foreign affairs the last few days. Understandably, he's been overseas and dealing with the situation in Iran. But now this is a signal that he's fully focused on this, and he's going to push the lawmakers to get this done. He's also sent that message you mentioned at the top that lawmakers need to stay in town here in a very hot and sticky Washington nonstop until they get this done, July 4th or whenever. That's very unpopular, I can tell you, with lawmakers. We'll see if that happens in a few coming days.
Ben, thanks so much. The Congressional Budget Office, known in your hood as the CBO, estimated that the GOP's tax bill will increase the deficit by $2.4 trillion over the next 10 years. University of Pennsylvania's Wharton budget model estimates that it could increase by as much as $4.3 trillion, with the Senate and House hoping to have a finished version of the tax bill ready by July 4th. This could be the next big piece of economic data. I want to bring in Brett Ryan, Deutsche Bank's senior U.S. economist. And still with me, we've got Thomas Hayes, Great Hill Capital chairman and managing member. Great to have both of you here on set for this conversation. Brett, as we consider what Ben was just breaking down and teeing up and what we're seeing in the difference of long-term costs that are anticipated here, how are you and your team kind of running the modeling around this?
Yeah, sure. So you have the near-term impacts, which, all of the tax benefits, especially for businesses and some of the individual measures are front-loaded, but the cost savings are back-loaded. And, we've seen this before. And the question is, are you ever going to realize those cost savings? There's obviously substantial debate over Medicaid, and that's where a good chunk of the cost savings are coming from. So there is a very real question around that. I think near term, it's probably about 100 to 150 billion of additional stimulus to the economy on top of the extension of the TCJA. So, you keep things baseline, and then you're adding about another 100 to 150 billion over the next, let's call it 2 to 3 years.
And so, Tom, there might be people out there wondering, why is this the next major catalyst for the markets, knowing that we've already moved through the Fed's most recent decision and they gave some type of or at least alluded to how they're thinking through certain aspects when asked about it. And then additionally, we already had stronger Treasury auctions that took place the week prior to that as well. So what is the larger implications that traders and investors are thinking through in their mindset?
the most important thing here is the tax cuts. Okay, so we've gone from bombing and tariffs to growth and deregulation, and growth is a function of the tax cuts. As Brett is alluding to, it's a little bit stimulative here, and you can kind of talk a little bit more about that in detail. I would just say, so that's critical. So, if tax rates were to go up, it's going to impact earnings. It's going to have a negative impact on the economy, hiring, growth, the whole thing. So that's not going to happen. We've got the Treasury doing what they're doing with the SLR. We've got the tax cuts coming in and animal spirits coming back because management can plan. They can start to forecast, kind of understand the rules, whereas the first half of the year, everyone was uncertain. So, Brett, how do you handicap this getting done by July 4th, or no vacation, no one goes home, locking them in a room? You've been through this process many times. Does this look any different, or is this just the normal back and forth and eventually they get something done?
Yeah, I mean, it does look like the normal process of back and forth. It's just that they are the two biggest portions of this bill, which are soft cap and Medicaid, are still outstanding, and we're a week away. And so, our baseline has been that it gets done sometime after the July 4th recess. This is an arbitrary deadline. Yeah. There's the only thing that the shot clock here is the debt limit, and that's not until September or October. So could this slip till later? Of course, absolutely. But to your point about markets, this is a large anticipation. As we saw in the wake of the 2017 tax cuts, the share buybacks increased materially. That's one of the reasons why equity markets are probably a little bit bouncing back from all of these issues.
Yeah. What we've continued to hear from President Trump and some of his cabinet members is that the tariffs would pay for the tax cuts. What would the long-run effective tariff rate need to be, even as we're getting some of the kind of leaked announcements, or at least Truth Social posts that are saying, hey, they're going to be, or we're going to be collecting more in tariffs from certain countries than we already are? What would that long-run effective rate need to be in order for a true offset and mitigation of some of the larger sums that we've seen projected by congressional budget offices and some of the economists out there being?
Sure. I mean, it's not as easy as saying, X rate is going to translate into paying for it. At about a 15% rate going forward, you could theoretically pay for, $3 trillion of this, but at the cost of about $7 trillion of imports.
Wow.
And at the cost of growth at the same time. And so, there's what's eventually going to happen if you keep these tax rates in place permanently is you're going to have substitution effects. You'll move into, some will be domestically produced. There's also be demand destruction. So, it's not as simple as saying, okay, these tariffs are not being legislated. Mm-hmm. They could be removed at any time. Other countries are also not going to take them too kindly. The EU has already threatened retaliation if the 10% baseline tariff remains in place. So we have a bit of an issue in this, and one of the key measures of the tax bill, Section 899, is causing some consternation in markets as well, especially for multinational firms. And so, you have elements of the tax bill that are meant to be leverage and sort of a threat to really correct other countries' tax issues that will be addressed in trade discussions. Kevin Hassett says, okay, well, we're going to do these trade deals after the tax bill, but then Section 899 doesn't need to be included in the tax bill if we do the trade deals. Okay, which is coming first here, Kevin?
Right. Just as a follow-up to that, because we've often heard some of the officials and cabinet members talk about this being an administration that is focused on Main Street. But what you were just laying out seems like it benefits more of the businesses that, as exemplified, can be more quick with some of their import, are much more large and able to kind of shift around quickly because they have more dollars, more weight to throw around as well. So what does that mean for small businesses and how they're able to wade through a longer or a prolonged period that tariffs are going to impact them?
Right. I mean, that's a bit of the tension here, is that the tax bill does have a lot of good small business provisions in there. There's no question about that.
Bonus depreciation stays in?
Love bonus depreciation. Yeah. That's exactly. These are all good things. The problem is the small businesses are the ones that are least able to deal with the tariffs. Yeah. So you have this tension in terms of what you're trying to accomplish here and the goals that you're trying to meet. Not all of these policies are rowing in the same direction. And that's kind of one of the issues here, which is going to ultimately outweigh things. Now, the tax bill, as Thomas mentioned, is going to provide at least some certainty here. every 90-day delay is another 90 days that companies are, well, I'm waiting to see what shakes out. And so the sooner we can get done with that, the better.
We have 30 seconds left here, and we were discussing earlier what the signaling of who the next Fed chair could be might look like in terms of commentary that we could hear from that person in a almost shadow Fed, because that person wouldn't be going in until May 2026, but we'd get more inclination through what they're willing to talk about openly and publicly, and policy could be one of those areas where the Fed typically will not comment on that and try to be apolitical, yet you would have someone who would be put forward in their name and have pretty much open season to say whatever they want leading up to that point.
I think it's less what they say and more who they are. Yeah. So, if Hassett's the guy, I think the market starts to discount that pretty darn quick, and that's going to have long-term implications in terms of refinancing the debt, the cost of the debt, et cetera. But I have one last question for you, Brett. What do you think, as the bill stands right now, what do you think that adds or detracts from GDP in the short term over the next 12 months? If it went through today as is, incremental benefit or drag?
Yeah, it would be about 40 basis points positive.
Wow.
Depending on where you put some of the scoring. But yeah, from a deficit, from a fiscal impulse perspective, 30 to 40 basis points positive, for sure, relative to trend. And so, that's if the Fed's trend is 1.8, you're looking at 2.1. Our forecast is around 2% next year. But again, a lot remains to be seen. Fed chair, that's a whole different.
That's another hour.
I think the next Fed chair, you have to be careful, as you alluded to. If the market loses confidence that the Fed is independent, then your long end is going to be a serious problem, and it doesn't matter how much you cut the front end.
Brett, thanks so much for taking the time here. Joining us in studio, Thomas, thanks for staying with us for the conversation as well. You stick around. We've got much more ahead on Market Catalyst. Time now for some of today's trending tickers. We are watching Salesforce, PayPal, Block, and CoreWeave. First up, Salesforce CEO Mark Benioff says that 30 to 50% of the company's work is being done by artificial intelligence. This move to embrace AI that led to the software company cutting over 1,000 positions this year to make room for the technology. Cybersecurity giant CrowdStrike and other tech companies are making similar decisions to embrace AI. Let's bring back in Thomas Hayes, Great Hill Capital Chairman and Managing Member, back in for this. Okay, we were talking about some of these cuts as well and the move towards AI, how that's impacting not just headcount, but the productivity gains that we're seeing across some organizations. It seems like another similar story.
Yeah, there's no question about it. I think, again, that the where you want to be focused in the second half is not the obvious AI plays. It's in the Brad Jacobs of the world, like the GXO Logistics with the robotics, with the QXO with the building supply, applying these technologies. Brad Jacobs bought Beacon Roofing Supply, and he paid 11 times EBITDA, and everyone's like, oh, isn't he like a smart value guy? He kind of overpaid because he needed a platform company. He goes, no. We're going to implement these technologies, and we're going to double EBITDA over the next few years. So he effectively paid 5 times EBITDA. And you're going to see more and more of this in boring industrial companies, in consumer products companies, and the like. So this is the next theme to pay attention to, not to discount the benefits and the NVIDIAs of the world. They'll continue to do great. But to look for, where can I get doubles and triples, not incremental growth of things that have already run up.
But, when Mark Benioff says something like this, does it essentially signal that there is even more productivity that they can extract from the AI use cases that they're already seeing internally at their companies?
Oh, yeah.
And the number of other major software companies out there that are trying to do the same thing while also selling solutions to their customer base.
Look, when Mark Benioff talks, you have to listen, okay? And if he's doing it in his own company, guess what the next step is? He's going to be doing it for all the other consumers, the clients of Salesforce, and helping them to become more productive. But in the short term, it looks like a panic. It's like, oh, everyone's going to lose their job. In the long term, what we know is all these new technologies create new cottage industries, create new jobs, create new opportunities. So in the short term, term, there is some dislocation, increased productivity for sure. In the intermediate and long term, it creates new industries, it creates new servicing, it creates new things that we don't even know that we don't know. And that's just the beauty of progress.
Next up here, I want to talk about cryptocurrency exchange Kraken announcing a peer-to-peer payment app, putting it in competition with Block-owned Cash App and PayPal-owned Venmo. We're seeing those stocks edge lower on this news, and this new platform will allow transfers of crypto and fiat currencies in an effort to further expand Kraken's business to more than just digital asset trading here. I think this directly speaks to how much of the mindset among the, not even just the crypto curious, but the crypto core out there that are holders and hodlers of crypto long term that have already recognized how much they engage with some of the newer platforms like a Kraken versus some of the legacy platforms. Yes, we can call them legacy at this point. In PayPal and in, of course, Square or Block.
Look, this is just a headline. Okay, Kraken, I mean, Cash App is a lower quality business. Block is a lower quality business. PayPal is a superlative business. We own PayPal. It's 453 million users. They're generating record free cash flow. They're buying in 20% of their stock. By the way, they're the 6th largest issuer of stable coins. So they are in the game. They just announced the deal with the Big 12 where the players are going to take their payments through PayPal, through Venmo. That's going to create a lot, and you're going to get your team cards, team credit cards, team bonuses. That's going to create a lot of buzz around the millennials and around the Gen Z. So yes, Kraken's getting in the game, but no, they don't have 450 million active users, 2 decades of brand equity, comfort, et cetera. And Alex Chris, who ran the business division for Intuit, which was a monster multi-bagger, he's applying his innovation to small business at PayPal. It's just early days for the new PayPal since he's come in just over a year.
Finally here, we got to talk CoreWeave. CoreWeave's CEO is now among one of the richest executives in the world after the company's meteoric 300% surge. CoreWeave is now one of the 30 best performing stocks on the NASDAQ since its public offering. You're taking a look at shares here, adding on about 0.7% in a move higher here on the day. But if you were to fire up the Yahoo Finance platform and go towards a longer term look, since this company went public, and this is not even factoring the day one pop, I don't think, 302% moved to the upside, and that happened just earlier this year as well. And so this really getting us back into the mind frame of what the appetite for investors and the clamoring among investors for new names who can show profitability or show a pathway towards getting to sustained profitability, making their market debuts actually is right now.
Yeah, look, there's pent-up demand, and Wall Street's very good when the ducks are quacking, you feed them. So right now, CoreWeave is the only place to put your money if you want to get some of this action. In the next few months, you're going to see dozens and dozens and dozens of opportunities that dilute the CoreWeaves of the world, which is a GPU reseller, and you're going to see a little bit more moderation in those price increases.
When the ducks are quacking, you feed them. All right, cool. Go feed them on a different side of the lake, not where the fish are, because that's where we're fishing. Thanks so much. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Switching gears, shares of Nike rising ahead of fourth quarter earnings reports. That is going to drop after the closing bell today here. And here with the preview, we've got Yahoo Finance senior reporter Brooke DePalma. Brooke, what should investors have their eyes on in this report from the swoosh?
Well, let's be clear here. One analyst saying that this is going to be a painful report from Nike this morning, or this afternoon, rather, after market close, as really Elliott Hill, that new CEO that joined last fall, is really attempting this large turnaround at the company. They're also navigating those tariffs and deteriorating consumer confidence. Now, in the last quarter, Nike had actually warned that those tariffs and excess inventory, as well as this uncertainty around that consumer confidence, would hit gross margins in the fourth quarter by roughly 400 to 500 basis points. He also warned that Q4 revenues were expected to be down in the mid-teens range. But if you take a closer look at what exactly Wall Street is looking out for in this report, they do expect that Q4 revenue to fall by nearly 15% to $10.72 billion. They also expect adjusted earnings per share to take a big drop here year over year, down 87%. Same-store sales also expected to come in lower yet again, down 2.62% this quarter, once again after market close. Now, one analyst also saying that progress made is good for the company. So we expect to hear more about how exactly they're cleaning up that inventory, really managing those iconic brands like Jordan and Nike Dunks in order to understand what exactly the right amount is here to have on the site to make sure that they're obtainable but also desirable. Innovation, we want to hear more about Jordan Retros as well as that Nike Skims collaboration with Kim Kardashian actually was delayed. So we're curious where that stands now. And something that they've walked away from, we want to see them gain those relationships back with their wholesale partners. They walked away from companies like Foot Locker and Dick's Sporting Goods, which is now acquiring Foot Locker, to really focus on their D2C business. Maybe that was a bit of a mistake here, but bottom line, guys, they need to bring back foot traffic. They need to get consumers back shopping with Nike.
You know, it's been amazing to watch some of the different strategic moves among the brands that they own. I mean, this is a company we're talking about that not only has the swoosh, they also have, of course, as you were mentioning, this new partnership with Skims. They've been leading into some of those collaborations. And then additionally, they've got Jordan Brand, which they've leaned into. Oh yeah, don't forget Converse as well, where they just had one of their stars win the NBA Finals. So all of these things considered here, they've got different levers that they can pull. And my goodness, I don't know if you had the Air Jordan 1s when they first came out, Thomas, but they're about to hit Jordan 40 right now.
Oh my goodness,
wow. Throughout my feed.
That's a scary
Listen,
thought.
the most important thing they've got is Scotty Scheffler. You know it, I know it, everyone knows it. I love a great turnaround story. You know, you were going through all those negative points, Brooke, and all the analysts are so negative in the hole. You know,
trying to get past this.
Yeah, it reminds me of, other than that, how was the play, Mrs. Lincoln? But I love when the market's so pessimistic. They did screw their wholesalers to say it. They've got to rebuild those relationships. They're going to. You know, my nickname on the street is Turnaround Tom. I would love to buy a lot of Nike. I should be buying a lot of Nike at these levels. I really hope it goes down a lot after earnings, and maybe that'll be a new position. But, you know, I'm betting on another turnaround specialist, Bracken Darrell, over at VF Corp. He's got his work cut out for him. He's going to turn that business. So I don't know if I want to be overexposed, but man, fresh capital. If this thing is lower, I'd probably be inclined to buy it with a 3 to 5 year view.
Are you talking about a low below what we've already seen? I think they struck 52 earlier this year.
Yeah, I'd love to see approach that level. If it did, I'd be inclined. Like, at some point, you got to stop watching and step into the ring. You look. I think the turnaround is going to be slower than the optimists think, but I think it's going to be certain. This is a company of winners. They hire the best. They get the best athletes using their stuff. They got to get back to winning. And they will get back to winning, and they've got to rebuild those relationships. So maybe we'll see some signs of that tonight. I don't anticipate it's going to flush out to the level that would attract me. It probably, we're at the stage where you're going to see some good news would be my expectation, because expectations are so darn low.
Yeah, and I do want to point out, year-to-date shares are down more than 18%. We're around $61 per share right now. But what we're hearing, or what I'm hearing from my sources, is that this is going to be a V-shaped recovery, that we have to hit somewhat of a bottom before we're going to bounce back. It's ultimately what they're saying is going to take a few years. And I know that you said this outlook for 3 to 5 years. Could it take that long, you think?
Yeah, but you know, 3 to 5 years for a double is a good IRR. So like if you run money, if you can get a double in 3-4 years, that's a good return on capital, and you're going to outperform the S&P doing something like that and be able to sleep like a baby at night and put a lot of money to work. And the one thing that no one's talking about is the Chinese government with the massive stimulus. They're going to probably do some more stimulus. We saw the headlines out this morning. They get China back. They got time to rebuild the relationships with the wholesalers here in the West. So a lot could go right, but I think it'll take longer than the optimists think.
All right, I've had the opportunity to meet Elliott Hill, and it's rare to see a group of employees really rally around a new leader. We will see exactly what they have to say after the close today. Brooke, thank you so much, Tom, sticking around. We've got all your markets action straight ahead. You're watching Market Catalysts. Just over 2 hours into the start of trading, let's go live to the NASDAQ in Times Square to get a read on the biggest factors moving markets today. Joining us now, we've got Yahoo Finance's Ali Canal. Hey, Ali.
Hey, Brad. Well, things are looking good so far. We have green across the screen here. The Dow is up the highest here out of the major indexes, up around 0.7%. NASDAQ Composite and the S&P 500 both up about 0.6% here. And the NASDAQ 100, we saw a record there the other day. We're continuing to see some of those gains, even with the equal-weighted NAS 100. We are up about 0.5%. If we take a look under the hood of the NASDAQ, let's take a look at NVIDIA, because that is is one stock that just continues to chug higher here. We are off some of the session highs, still up about 0.7%, trading above $155 a share. We'll see if these gains can hold, and maybe we'll see another record close there. You're also seeing gains for Amazon, Meta, Alphabet. But interesting to see that Micron is down about 1% right now. We did see a stellar earnings report there, but right now, we're struggling a little bit. So one thing to keep an eye on, but again, we're seeing that NASDAQ 100 continue on with those gains here. And finally, I want to take a quick look at Treasury yields because yields are moving to the downside today. We did get an update from the president that he wants to pick a Fed chair sooner than later. He is targeting maybe September. Now, this would be before Jerome Powell's term is officially over. And we know that the president, he does want a more dovish central bank leader. And we are seeing yields react somewhat, not really, mostly flat, 4.3% for the 10-year and the 30-year bond at 4.8%. So yields, the dollar also edging a little bit lower today. We are still below that critical 100 level as U.S. exceptionalism is questioned a bit. But for now, a pretty stable market. We'll see if some of these gains can hold. We could get that record for the S&P 500 along with potentially maybe NVIDIA. Who knows?
Ali, thanks so much. Appreciate it. NATO members agreed to massively ramp up military spend at this week's summit, driven in part by pressure from U.S. President Trump. But that support was not universal across the organization's 32 members. Spain officially refused the plan. In response, Trump threatened the country with a tough trade deal. Joining us now, we've got Kevin Barron, who is the Elevation Global Strategies founder and president. Kevin, good to have you here with us. So what does this essentially say about how we're working with some of our broader international partners and where Trump is dialing up more of kind of the hardline approach and what that could mean for some of the other areas that we're continuing to negotiate, notably on tariffs?
Well, so if you think of the history of NATO spending, right, this 5% number, everyone should know, is an agreed, basically, suggestion. These are not, these are not legally binding numbers. It goes back to a long, long history where national security experts often thought and advocated that all countries should be spending 4% of their GDP. So back in the Obama days, the NATO members agreed to do 2%, and then it's kind of has become old-fashioned, and we want more. The question is, how do you count that number, right? For especially in the age of cybersecurity, there's a big debate in the defense community of whether or not cybersecurity alone should be counted, in which case every country would be way past that number, according to lots of analysts. So what this does, though, it gets everyone on the same page in NATO. It is very important. It's another milestone that signals to the capitals of the NATO member countries, who are just like the United States, hold the purse, that it's time to start stepping up. And this has been going on for a couple of years now. Trump gets a lot of credit for pushing the gas pedal a little harder than it already was when he came to office last time around. And the Ukraine war gets the rest of the credit for forcing Europe's hand to say, okay, times have changed, enough is enough. What a lot of us are looking at is how those countries will reach that number and what each country will do with their spending. So if you think of NATO in Europe, kind of like the United States with 50 states, all these different countries can build different things. Someone's going to have to build the tankers, someone's going to have to build the fighter jets, someone's going to have to build the bullets. And that's what the new NATO is looking toward going forward.
And so does it seem like we, coming out of this summit, have any type of way forward that is at least something that hits the target for all of the countries that are involved, or at least discussions in a good place to continue ongoing in everything that you just laid out?
Well, yeah, the 5% number also has a timeline of when countries are supposed to target and reach it. And these are the countries, the politicians at NATO this week have to go back to their respective capitals and convince those legislatures and parliaments to pass the funding. They got to convince their publics, right? Trump's not going to be president forever by the time this bill is due. That's why the write-up of the agreement, the Hague Agreement that came out, includes a little bit of an out, mainly for Spain, which was not on board for making this an ironclad requirement. And so it says that allies will reach those goals. It doesn't say all allies. These are the little kind of minutiae that the NATO experts are looking at. What has been in place for a long time are, like I was saying, the agreements and decisions of what country is going to make what thing. partly because it takes a long time. You can't just flip a switch and suddenly Poland's making one thing and Slovakia is making another thing and the United States and Canada are making others. They have to build up not only the physical infrastructure and to manufacture these goods, but the workforce, the knowledge base. So there are folks that say politically it's great for Trump to, if you believe and you like the way he's doing it, to bully Europe into spending more on their own defense so that the U.S. doesn't have to. But the reality is this is a 10-year plus project for Europe to get anywhere near the capabilities that they have with the United States. And frankly, many people think that'll never happen. Europe will never have the capabilities that they have with the United States. So that's why you have to find the balance.
And so, Kevin, in the backdrop of the NATO summit, you also had what was announced at the onset of the week in a ceasefire between Iran and Israel, only for that seemingly to be violated just hours later. But now it seems like we're at least off of the heightened levels of the attack that ramped up over the weekend. So as the U.S. and Iranian officials are set to apparently talk next week, according to President Trump, what does the true long-term ceasefire look like?
Well, the long-term hope is that Iran will come to the table and let the world in and see exactly what they have, what kind of uranium, what kind of capabilities, all of it. I don't think anybody believes that's actually going to happen. That's why Trump says they make the argument that they had to go ahead and launch these strikes. It's been years, if not decades, of negotiations, and enough is enough. So no matter what you believe in the politics, here's where we are. The Pentagon just had a press conference with Pete Hegseth and Chairman of the Joint Chiefs, General Kane, this morning, where they brought out for the first time the maps and imagery to kind of explain how they attacked the site. But they really did not give a definitive answer of what they know. And they were pressed to say, did Iran move the uranium before those strikes or not? So we still don't have a clear intelligence answer to that. And there's some good reason to that. The U.S. community doesn't want to reveal what they know exactly. But we're hearing plenty of public reporting showing that the Europeans believe something different, and they're saying it, than what the Americans believe, which was different than what the Israelis believe. So there's a lot of fallout to go through. But the hope is that the long-term hope has always been Iran ceases to pursue a nuclear weapon, but also Iran stops funding proxy terrorism throughout the region, right? This is the reason Trump abandoned the original Iran deal. It wasn't because of how it limited Iran's nuclear weapons. It was because of payments and money releases that go with it. But it was because they thought the deal should have always included a stipulation that Iran stop funding proxy terrorists, which is the Houthis, the ISIS, Al-Qaeda over the years.
Great evaluation and assessment. Kevin, thanks so much for the analysis and context as well. Appreciate it. All your markets action straight ahead. You're watching Market Catalysts. BlackRock, the world's largest asset manager, plans to provide public and some private data for a 401k target date fund offered by Great Gray Trust. That's according to the Wall Street Journal. This comes as BlackRock is pushing to bring retail investors into the private market, with its own funds becoming available for 401k plans starting the first half of 2026. I still have Thomas Hayes, Great Hill Capital Chairman and Managing Member, with me here. And as we're taking a look at shares of BlackRock, they're up by about 1% here on the day. Is this really expected to move the dial longer term here? Why does it make sense for BlackRock to do this?
Yeah, I think they're doing it because they can. Okay, it's a huge market. The idea is to democratize private equity, but you see they follow the trends. First Larry Fink said Bitcoin was no good, and then the thing took off, and then he started offering it to the public with the ETFs, et cetera. So I do think that there's going to be a place. This is going to be promoted by a lot of financial advisors. This is going to be a part of the portfolio. The beauty of private equity and private credit, which have become so popular, is that you have no mark to market. So it's perceived low volatility because they mark the assets, what we used to say during the great financial crisis, mark to make believe or mark to whatever. And you never really see a mark until the asset is worth zero, until it's fully marked down. So in a bull market like this, everything's marked up, everyone's happy, there's no volatility, you don't see that daily volatility. Retail loves that. Institutional consultants love not having the volatility. They love their sharp ratios when they come in, the 25-year-old with their clipboard. But when you take the marks are big. So I think there's going to be a place for this in a lot of 401ks and for a lot of retail investors are going to try their hand.
Yeah.
But as you move into a recessionary type of period, these are the assets that you want to be careful of.
Yeah, I was taking a look at one of the charts from Torsten Slok, Apollo chief economist, saying private equity as a percentage of public equity market, 2003, 3.8%. 2024, 8.8%. That's some of the growth here that we've seen. Tom, it's been great to have you here on set with us. Thomas Hayes, who is of Great Hill Capital and taking some time here in New York with us.
Thank you so much. Thanks for having me.
That's it for Market Catalyst, everyone. I'm Brad Smith. Thank you for watching. We've got more Yahoo Finance ahead.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned